show. So let everybody welcome Tony Sessions. Thanks, everybody. Mike Favecchio is my associate. Most of you know him. He's here to call off or kick me if I say something that's wrong, or if somebody asks a question that completely stumps me. I want to talk about the state of the market today, and to do that, I'm going to name some names that you're probably all familiar with. Countrywide. Countrywide was once the largest mortgage bank in the country. Washington Mutual was the largest savings and loan in the country. Ameriquest was the largest subprime lender in the country. You couldn't watch a baseball game or a football game without seeing Ameriquest's name on the left field wall, in the end zone, certainly on TV. IndyMac was the largest Alt-A lender in the country. On Long Island, the biggest lenders were American Home Loan. They were the 9th largest bank, mortgage bank. We had Delta Funding, which was the largest subprime lender on Long Island. And then there was Lend America, which was a large lender who did infomercials constantly. If you lived on Long Island, you could not avoid it. Then there were a whole host of subprime lenders. I just jotted down a few names. Argent, Long Beach, Option One, Saxon Mortgage, Bloomington Financial. What do they all have in common? They're gone. They don't exist. All of those lenders do not exist. But they took with them some of their products. Some of the products, I'll tell you about. They were called no-doc loans. They were called NINAs, N-I-N-A, which means no income, no asset. SISA, S-I-S-A, stated income, stated asset. There were things that were called pay option arms. These were loans where the customer, the borrower, had options as to what to repay. He could repay the principal, the interest. He or she could repay just the interest. Or they had a choice of paying a much lesser amount every month. The difference between what they owed and what they paid was added to the loan. That's called negative amortization. So the loan, instead of going down, went up. And when it reached a certain point, most times when it reached 110% of the original amount, then the full payment kicked in. No one could afford the full payment. So these kinds of products, in my summary, I refer to them as toxic mortgage products, because that's what the press has labeled them. The other term they use to sort of sum these all up, liar's loans. I'm sure you read about it. You've seen that term. A liar's loan is something where there's no verification. People lie. Those products are all gone. They don't exist. Today, we've got to qualify people. We've got to qualify the borrower, and that's the name of the game. It is like it was 20, 25 years ago, when people had to actually qualify. That's where we're at. The other changes in terms of what's involved today, there are fewer lenders, as I just indicated. There are fewer investors buying these loans. So the market is much smaller. Wall Street has taken a back seat. They're no longer active in purchasing mortgage loans. So it's a much stricter, tighter, smaller market. The terms we toss around today that didn't exist a few years ago are things like short sales. Everybody knows what a short sale is, I assume. REOs, real estate owned, bank-owned properties. Liz pendants. When we demonstrate geodata, we show you how to find all the Liz pendants, lawsuits pending, foreclosure lawsuits. Today, we up front, up here, face what's called the NMLS, the National Mortgage Licensing System. We have to be licensed. We have to be educated. We have to pass tests. We have to be fingerprinted. We have to run credit reports before you can be in the mortgage business today. So our license number appears on all our business cards. We also face something called HVCC, the Home Valuation Code of Conduct. That addresses the relationship between originators like us and appraisers. we can no longer communicate with them. They don't have to talk to us. They don't want to talk to us.
They don't.
They don't talk to us. So people will say, well, who's coming out to the house tomorrow to do the appraisal? And my answer is, I don't know. Because an appraisal now has to be ordered through a management company, and that management company chooses the appraisal firm. That firm chooses the inspector. Years ago, it was easy. I pick up the phone and talk to one of my appraiser friends, and we'd be finished. Not that way anymore. Now that affects all banks. So it's a question that's frequently asked. Who's the appraiser? Is he going to do the right thing? And the answer is, he's going to do the right thing, but I don't know who he is, and we can't contact him. That's HVCC. Another thing that affects us, and is really important for us, not so important for you, is a term called overlays. Overlays are rules, they're regulations that the various investors impose that are more stringent, more restrictive than, say, the FHA imposes. All right, we'll talk about FHA in greater detail later, but one of their guidelines today is that the minimum credit score is 580. However, many of the big investors require 620, 640, or 660. Those are overlays. Something that just came up the other day that's tightened up in the business. Today, if you're buying a 2, 3, 4 family, we're counting rental income to qualify you. The insurance policy you have has to have rent loss coverage. That's something new. Another change is you're buying a condominium. The condo has insurance that protects you. You are now required to get what they call walls-in coverage that protects your personal property. So investors have imposed all of these changes, which makes it a bit tough today. But that's what we're here for, to tell you the keys in terms of qualifying people. So I go back to an old phrase I used to use when I would teach new guys coming in. There's two basic questions that are asked in the mortgage business. The first one is the borrower ready, willing, and able to repay the loan? And then the handouts I've given you space to take notes, to write. And feel free to ask questions at any time. Ready, willing, and able. I translate that to ready is, they have enough money. They're ready to purchase. Willing. Are they willing to repay? How do we know? Well, their credit history tells us their willingness to repay other debt in the past. And are they able to repay? Able means they have sufficient, verifiable income. So I translate ready, willing, and able into assets, credit, and income. Those are the three keys today for a borrower to get a loan. I'll start with the assets. What do we mean by assets? Money. How much money do you have? The fancy term we use is sourced. If someone has just come into some money, we need to source it, find out where it came from. If they went out and borrowed it, that's a problem. Because borrowing money to get a mortgage, you're borrowing to borrow, is unacceptable. So we need to see sourced assets. Something very commonplace today, retirement funds. People can tap their retirement funds to buy a house. That is a method of borrowing. However, it's acceptable because you're borrowing your own money. You're borrowing money you set aside for retirement, and when you repay it, you're repaying yourself. So it's perfectly acceptable. It's something that you should always consider when someone doesn't have enough money. If they've been working for the post office for 15 or 20 years, they probably have a TDA, a tax-deferred annuity, money they can tap. Another source, and it's very common on FHA loans, gift money. FHA will allow 100% gifts. We'll get to that later. But you can literally buy a house with none of your own money with FHA financing. It can be all gifts. And we have to document it. We have to prove it went from the donor to the borrower. The donor has to be a relative. To sign a gift letter. But gifts are a very important part today. They've always been an important part of assets as far as FHA financing house. The typical asset, though, is a bank statement. Savings account, checking account, a CD, a money market, stocks, bonds, any liquid asset that the customer has can be used towards their assets. What do they need? How much money do they need? Well, there's two basic things. They need a down payment. FHA will allow you to put down as little as 3.5%. And you need this thing called closing costs. We'll get into that a little later. There's a handout where we'll go into some detail. So down payment and closing costs. That's the amount of money we need to verify. Right? Any questions on assets? I ran through it kind of quickly because it's pretty self-explanatory. Buying a house, you need some money. Anything. Okay. The next section, the willing part. Is the customer willing? How do we know? It's called a credit report. I'm sure you're all familiar with credit reports. And nowadays, credit reports have what are called credit scores, or technically FICO scores. FICO stands for the Fair Isaac Company. That's the company that developed this scoring system. We use the middle of three scores. It's like the Olympics. You throw out the high and the low, you take the middle score. That's the operative score. And since loans are looked at initially by computers, it's not a human being, it's a computer, an automated underwriting system, those scores are very, very important. They're critical. Yes?
I've been told that the credit score that you run is different from the credit score that a person usually get a degree into any credit score. Why is that different?
That's true, because Fair Isaac charges for that score. We pay to get those three scores. If you call and get a free credit report from freecreditreport.com, you might not have any scores. They might not give it to you. If you go for a car loan or some other form of credit, they'll use a different scoring system. We had a situation recently. It was an attorney. No, pardon. He was a friend of an attorney. He claimed he had a credit score of 900, and he did, but it wasn't a FICO score. FICO scores go from 350 to 850. You cannot get 900. That was a different scoring system.
There's a government-sponsored one, annualcreditreport.com. So is that different from what you guys have?
We're going to run what we use in our business is called a tri-merge credit report. We're going to look at all three repositories. Okay, then it would be similar. You may not get a score. Okay, you may not get three scores. You may have to pay for the scores themselves. So you can get three scores on a tri-merge and pay for it. Obviously, we do it for every customer. The credit report, besides giving us a score, tells us how much people owe, how they pay. It tells us if there are any negative items, like bankruptcies, foreclosures, judgments, charge-offs, collection accounts. There's a whole host of negative items which will obviously push your scores down and make it more difficult to get a loan. Late payments, say, on a mortgage are much more severe. They're much worse than late payments on a Sears card or a Visa card. Somebody's got late payments in the last 12 months. I see somebody smiling because we occasionally come across this. It's practically impossible to get a loan today. Okay, so mortgage payment history is critical, whether you're buying something new or refinancing. Any questions on credit?
What about this thing that keeps popping up over Les did tell us about this question of every time you do a credit check?
Good point. It's a common question that's asked of us. It's called an inquiry. If you apply for a loan, someone's going to run your credit. You're going to give them your authorization, okay? And that inquiry will come up. Now, if someone runs around to 7 or 8 different lenders, and there are 7 or 8 inquiries, that is going to have a negative effect on your scores. It will lower your scores. It's going to vary. There's no set number we can tell you because we don't know. But it's not something you want to do. The customer wants it. On the other hand, if you have your credit checked 2 or 3 times for a mortgage in a 30-day period, that's treated as one inquiry. That will not destroy your credit. A lot of people think it will. It will not. Again, you don't want to have people run around and have their credit report run 7 or 8 times. It's a common complaint. People don't want us to run their credit because they're afraid it will affect their scores. If they have good credit, the effect on their scores will be so minimal, it will have no impact. But again, you don't want to do it 7 or 8 times.
And Tony, a quick question.
Sure.
Don't those points come back? Doesn't that point come back after a window of time?
Over time, correct. Credit scores can be repaired, so to speak, or improved with time. You had a late payment 6 months ago. Well, 6 months down the road, that payment is a year old. Your scores, it's not going to have as great an impact. A recent late payment will obviously have a greater impact. So the older the derogatory item, the less impact on the score. If something happened 4, 5, 6 years ago, we don't really consider it, unless it was a judgment or foreclosure. But if you had a couple of late payments on a credit card 4, 5, 6 years ago, the effect is minimal. It's the last 12 months that really has a big impact.
How long does it take for the inquiries to go on?
Good question. How long will it take? I think they'll stay there, I think a year, but I can't swear to that.
Less.
Less? See, that's something we wouldn't know because we run the report, we see the inquiries, and we deal with them. We're not generally going to rerun that report unless it expires. That's a good question. I'll question the credit companies on that.
I've seen it say credit inquiries within the last 90 days.
Okay.
So if it's over 90, it normally comes off the report.
Things like judgments are going to last for 7 years. Bankruptcies for 10. Okay. So credit is obviously an important part of what we do, and we try to do it first. That's the first thing we attempt to do. In the package is a little handout. It's in there. It's a very simple form, which I'm sure you've seen. We hand it out in the offices. It's an authorization where a borrower gives us the key information: name, address, social security number, and at the bottom there's a signature line. We get that piece of paper, we're authorized to run the credit. Everyone see it? Like this. I put it in order, so it should be the first handout. There's also some information there for employment and income and assets. So we try to create what we call a quick qualifier. We have this information, it makes it a whole lot easier to determine if someone's qualified. But we use it primarily for credit authorization. All right, so name, address, social security. I personally always try to get the date of birth. It's not required. It's just, it helps separate, for instance, if there's a father and a son. You want to make sure you have the right person. All right, any questions on credit? One other item, a very important credit item that will not appear on a credit report is one's rental history. If someone has minimal credit, poor credit, we're going to want to verify, if we can, their rental history. Because how are you going to pay a mortgage, which is your housing expense? You might pay it the same way you paid your rent, previous housing expense. So what we try to do is get 12 canceled checks. There's nothing better than canceled checks to prove that someone paid on time. Sometimes it's required, but generally not. It's something extra to sort of offset a negative item that we look for. Well, I think the front and back, sure. Yeah. If someone pays a management agency, they live in a project, then a letter from the management agency would suffice. If you live in your cousin's basement apartment, you need the checks. That's where you run into some problems because you can't take the letter from your cousin. Well, cousin probably wants to get rid of you. He'll say anything. Okay? I mean, that's just a fact. So canceled checks are the best form of proof.
So what if the person says all they have are receipts? They can enforce, right?
Yeah, they can. Receipts, they don't carry a whole lot of weight. You and I can make up receipts. So the canceled checks or the what's called a verification of rank, generally acceptable from a management agency. Those are the two things.
Some people are paying money back.
It's very difficult. You're not going to have people in general who are going to take their last 12 months. Cancel checks you can get. Even if your bank doesn't provide them, you can contact the bank and get photocopies. And again, that's not a standard requirement. That's something that's required when somebody is a little bit weak credit-wise. We call it a compensating factor. If the credit scores are marginal, we want to prove that they paid something on time. And that something is an important something as your rent. Your previous housing expense, because you're looking to buy a house, you're going to have a mortgage for your future housing expense. Okay?
When we truly need that rental verification, we'll delve pretty deep into exactly how an individual does pay his rent. I had a situation just recently, he paid it in cash every single month because the landlord wanted it in cash.
Yeah, some people do.
So what we did, we had 12 bank statements. And now with the internet, you just zip them off the computer. And every single month, on the first of the month, there was a $2,000 withdrawal.
That's pretty compelling evidence that someone has in fact paid on time. You've got a history. Okay? So that's the willing aspect. The third question, able. Is the borrower able to repay the loan? That's income. How much income do you have? Your standard income, if there is such a thing, is a job. And the standard documentation is pay stub, W-2 form covering 2 years, and nowadays, tax returns covering 2 years. So the pay stub for 30-day period, that's generally what's required, it's going to tell us what the base pay is. W-2 is going to tell us what someone earned over the previous year. So we can give them credit for extra income, bonus income, overtime. Tax returns are nowadays required. This is something new. Investors have started requiring it. They present problems for us because they'll almost always show the proper income, but sometimes they'll show what are called unreimbursed employee expenses. The tax preparer found expenses that the borrower incurred. He's a bus driver, and he makes $50,000 in base pay and $10,000 in overtime. So we have a $60,000 income. But the tax preparer said he spent $500 on work shoes and $300 a year on clothing, and he had travel expenses and a whole host of things. And those expenses totaled $10,000. We've now got to deduct that $10,000 from the $60,000. That's why, and we'll talk about pre-approvals later. That's why a pre-approval that's done without all of the documents is meaningless, and we see it all the time. We try to gather the pay stubs, the W-2s, and the tax returns, so we have a clean picture of total income. All right? There are other forms of income that are countable: retirement income, pension, Social Security. We need proof. Copies of the checks, or for the most part today, monies are direct deposited. So the bank statements will show how much is going into the bank. It'll clearly indicate what it's from: pension, Social Security. Okay. Social Security disability is countable as long as it's permanent. So the fancy word we use for income, it has to be provable. Obviously, we have to document it. And it's got to be stable. It's got to continue. That's something we do. Obviously, we're not going to look into that. We're just going to try to figure out if your customer has enough income to buy that house. Alimony, child support. That's rare, but it can be used. It can be counted. Obviously, it has to be documented like everything else. Rental income. You're buying a 2-family, a 3, or a 4. We're going to give you credit for the anticipated rental income from the units you're not occupying. Big part of qualifying. Someone who can qualify marginally for a 1-family might qualify easily on a 2-family because there's more income to add. So you can buy a bigger, better house. You can qualify for more with that rental income. That's on all kinds of loans. FHA will give you more credit, 85%, as opposed to conventional. We only get credit for 75% of the rent. What else? Interest dividend income. every once in a while, you see somebody who has so much money in the bank that it generates an income flow that can be counted because it's going to remain there. Now, obviously, you can't use that money as a down payment because that will eliminate the income flow. So you cannot be both income and an asset. It's got to be one or the other. Kind of rare. So what we see in our markets are generally payroll income from a job, Social Security, pension income for retired people, and rental income. Yes?
I have a lot of young buyers. Is there a rule of thumb for like how long they have to be employed before?
Absolutely. The standard in the industry hasn't changed much. 2 years. We've got to document a 2-year work history. Not necessarily on the same job, not even necessarily in the same profession, but we have to document that they have in fact been employed for 2 years. There are some exceptions to that. A registered nurse. She's on the job for a year, but she went to nursing school to become a registered nurse for the last 2 years. So she got a 1-year work history, but a 2-year history of attending school. I would say 99% of the time, that's acceptable. That's an underwriting decision. Okay? That's a good example of how it almost always will be counted. A young doctor, an attorney, someone new in their profession who can document they previously went to school to get into this profession. The 2 years can be short of the 2 years.
So it could be a graduate student as well.
If a graduate student is now employed in the field they went to graduate school for, yeah, we want to document that. I have a transaction right now with a young woman who's a pharmacist. She works for Walgreens. And she literally brought me her diploma to prove she went to school to become a pharmacist. That's countable income, even though she's only been at Walgreens for about 1.5 years. Okay? So it is a 2-year history.
Can I tell a story?
Sure.
18 years ago, I had to ask Mr. Michael Reinhardt for his diploma when he became an attorney. Because he was furnishing a home, and he was only an attorney for 6 months. And he brought me this huge laminated degree from law school. We were very happy when he gave it.
If somebody else is short. Okay, any questions? So ready, willing, and able in our minds translates to assets, credit, and income. Those are the 3 things the borrower has to provide today to get a loan. The second question is, if the borrower doesn't repay for any reason, and there's a lot of reasons out there nowadays, is the property sufficient collateral? Is the lender going to make the loan and not get paid and take that house back? Are they going to be made whole? How do we know? Well, let's call it an appraisal. An appraiser is ordered, appraisal is ordered by the bank, by us. And an appraisal does several things. The first thing is he determines if the property is acceptable. Is it acceptable for a loan? Is it sitting next to a toxic waste site? Is it between 2 gas stations? Is it in a commercial zone? So those are obvious things that would make the property not mortgageable. But his primary function is to determine value. What is it worth? Because the value is going to determine the loan. It's called LTV, loan to value ratio. It's one of our definitions we'll talk about shortly. The appraiser generally is going to note if there are any special conditions, repairs. Is there a hole in the roof and water's leaking? Then have to fix the roof. Are the utilities turned off? Got to turn them on to determine if the plumbing, electrical, and heating systems are functioning. Okay. There was a time years ago when FHA was real strict with repairs. They've loosened up considerably so that you don't see a whole lot of FHA mandated repairs, except if it really affects the structural integrity of the property. Holes in the roofs would be something like that. Lead paint is another thing that can come up. All right. The appraisal process, obviously it's done by a professional, but you can help the appraiser make that deal. It's called comparables. I'm sure you're all familiar with it. An appraiser appraising a 1-family detached frame house in Marine Park that has 3 bedrooms He's gonna look for similar houses, detached, framed, 3 bedrooms, within Marine Park, and he's gonna see what they've sold for. And he or she's gonna make adjustments to condition, various amenities that each house might or might not have, and come up with a value. That's a very simplistic explanation of what an appraiser does. You can help. You've got tools to help. You've got geodata, where you can actually research comps. You may know of a comparable sale that just happened 2 days ago and hasn't been recorded anywhere yet. So you can help make your deal by being an expert in value. Okay? Questions about that fourth question rather? Appraisals. All right, good. Moving on, in the package, I've got some terms that we'll run through quickly, just to try to give you a picture of what's going on in the market today. First is FHA. Everyone is familiar with the FHA. It's the Federal Housing Administration. It's a division of HUD. And what the FHA does is, well, let me tell you what they don't do. They don't lend money. They don't process loans. They don't approve loans. The FHA insures mortgage loans. I think of them as a giant insurance company. They create a whole host of guidelines that individual FHA-approved lenders, like Continental, adhere to. We process, we underwrite, we close the loan, we lend the money. The FHA insures it, which makes it possible to lend money to people with 3.5% down. It makes it possible to lend money to people whose entire down payment is gift, or closing costs is gift. All right, so think of FHA as an insurance company. That's why they collect insurance premiums. We'll get to that in the closing cost section. The next is VA. What you need to know is that a veteran, an eligible veteran, is entitled to a VA loan. We are a VA lender. The key advantage of VA, it is the one loan around today where you need no down payment. You can borrow 100%. VA loans are for veterans alone or a veteran and spouse. You can't borrow with your cousin, your aunt, your uncle. Sonny Mae, next. Sonny Mae stands for the State of New York Mortgage Agency. We're a Sonny Mae approved lender. Sonny Mae sells bonds. They take these bonds and lend it at below market rates to people who fall into certain categories. There are income limits and sales price limits. That's really all you need to know about Sonny Mae. The regular criteria apply on all of these loans: income, assets, credit.
I'm sorry, could you just repeat it, buy bonds, they buy bonds?
They sell bonds. They take the money from these bonds and lend it out in mortgages and at below market rates, generally. So they create this set of guidelines where someone has to fall within a certain amount of income, and the sales price has to fall also within certain limits. Fannie Mae, Freddie Mac, you've heard about these agencies a lot lately. They're part of the secondary market. Okay? Lenders like us and big lenders sell loans directly to Fannie Mae, sometimes to Freddie Mac. They package these loans and sell securities. They have recently been taken over by the government. They're part of this colossal failure that has happened in the mortgage business. I read something recently. Between Fannie, Freddie, FHA, and the VA, those four entities, which is really the government, account for 97% of the mortgage loans originated today. That's an amazing number.
Could you repeat that again, please?
Fannie Mae, Freddie Mac, FHA, and VA account for 97% of the loans originated today. It tells you how the market has changed, how there are fewer investors out there, fewer ways to do financing. Ginnie Mae is another secondary market agency. They buy government loans, FHA and VA only. It's called the Government National Mortgage Association. Continental is a Ginnie Mae approved lender. So we can avoid those overlays I talked about by servicing the loan ourselves and selling it directly to Ginnie Mae. All right. The next section, loan types. The basic loan is a conventional loan. The term it's used is conforming. It conforms to Fannie Mae, Freddie Mac guidelines. A conventional loan requires a down payment of 20%. The flip side of that is the loan to value, the maximum, is 80%. If you go over 80, or your down payment is less than 20, you can still get a conventional loan. That is a conventional loan with PMI. That's private mortgage insurance. A private mortgage insurance company will insure the loan, and they will also have to approve it. So it's a double approval process. Both the lender and the mortgage insurer have to approve this loan because they're insuring the mortgage. Getting PMI today is a lot tougher than it was a few years ago. A few years ago, it was virtually automatic. PMI companies were scrambling for the business. Today, they're working real hard at every file. And they have their own guidelines that can be pretty tough. Yes. Fannie Freddie standards. Conforming, the word conforming means conforming to the standards established primarily by Fannie Mae and also by Freddie Mac. Yes?
So if you're approved by the insurance company, then you don't need 20% down, is that what the difference is?
Correct. Correct. You could put down 10%, the lender has to approve you, and the mortgage insurer has to approve you.
Is there a minimum?
Generally speaking, today, on one families, the minimum is 5%. Okay? Tough to get mortgage insurance. And when we talk about FHA, we'll talk about the advantages of FHA as opposed to PMI. And one of them is simply qualifying. It's a bit easier. Okay? Jumbo. That's
Before you go forward, that PMI, is there something that PMI drops off
yes.
after a certain time?
PMI drops off once the loan to value reaches 78%. 78. Years ago, when values were constantly rising, people would try to prove that the loan to value has dropped because their value has gone up. Today, we're in a declining or flat market, so that's not likely. You'd have to pay down that loan by paying principal to eliminate the PMI. Okay?
I see they wouldn't accept, say, an appraisal, say, after.
Yes, they would. They would accept an appraisal if that appraisal showed the value had increased to the point where the LTV is 78 or lower. It's just not likely because we're in at best, a flat market. We're not seeing, at least I'm not seeing, properties increase in value. But if it does happen, you can prove it as a customer.
Um,
That's FHA. Yes, FHA is a mandatory 5 years.
For the PMI?
Well, it's called MIP. We'll get to that when we talk about FHA.
I was told that FHA stays on the loan for the duration of the loan.
Not necessarily, no. FHA, the monthly mortgage insurance premium will go away if you've paid it for at least 5 years and the loan to value has been reduced below 80%. Okay? So you can eliminate it, but it's going to stay there for at least 5 years. No, FHA. FHA. The next term, jumbo. You've heard the jumbo mortgage. The jumbo mortgage is simply a conventional type loan whose limits exceed Fannie Mae's limits. Those limits are pretty high right now. On a one family, it's $729,750. So a one family mortgage above that number is by definition a jumbo. Much tougher to get today than ever before. Okay? ARM, next definition. ARM stands for adjustable rate mortgage. Adjustable rate mortgage is a mortgage that the interest rate and the payment is going to adjust or change. It can go up, it can go down. It's going to be tied to an index. Typical index is 1-year Treasury securities. That would be a 1-year adjustable. The advantage, you get a lower start rate. It's cheaper in the beginning. Could it go up? Yes. Could it go down? Yes. Yes. The disadvantage is you're not sure what your payment is going to be a year from now on the 1-year adjustment. All right? That you
There's
just,
different years adjustable rate, another 1 year, 3 years.
yes, so that's my next hybrid ARM. A hybrid is an adjustable rate where your start period, fixed period, could be 3 years, it could be 5 years, it could be 7 years. Those are referred to as 3 ones, 5 ones, 7 ones. Those are useful in a market like we're in today, where rates have bumped up a little bit, and we can't get a customer into a 5-1 on, a hybrid, where they're gonna get a lower start rate, and that rate is gonna be set for the first 5 years. Only after that can it adjust, again, either up or down. So you got 5 years where you know what your monthly payment is gonna be. Pretty powerful. Again, the advantage being, you're gonna get a lower start rate. Roughly, today, you could do a 5-1 FHA arm at about 3 3/4. Okay. Again, hybrid arms, that's the key advantage.
With these arms, is there a cap on how high it can go?
There are caps on all arms today. Years ago, some of those toxic mortgages I talked about had no caps. The typical cap on an FHA is a 1% cap per adjustment and a 5% cap over the life of the loan. So you're protected as a customer. That, if you start at, say, 4%, the worst it could ever be, the worst case scenario, is 9. Okay? It's never gonna go to 10 or 12 or 15. Different loans have different caps, but virtually all loans have caps. It's either 1 in 5 or 2 in 6. Those are the primary numbers you hear the most.
What's the one, what's the one?
The 1 is per adjustment,
Oh,
okay? Up or down by no more than 1%, and the 5 is the lifetime.
Sounds like subprime to me.
What I mean?
Sounds like subprime to me.
Absolutely not. It's just an adjustable. It's an ARM, a hybrid, where it gets you more house. You've got the protections on a 5-year of 5 full years of knowing what your payment's gonna be. And your caps are gonna protect you down the road so that you know the worst case scenario. Think about it. You get a 5-year arm at 4%. With a 1% cap, the worst thing that could happen is that 4 can become 5 in year 6. 6 whole years. Look at how much money you save over those 6 years as compared to a fixed rate loan which has a higher payment. If you think you're gonna relocate in 4 or 5 years, you're not gonna be in that house. An adjustable makes perfect sense. It would not make sense to take a fixed rate if you knew you were gonna be moving on.
Are you allowed to refinance if you do an arm?
Yes, FHAs are, and that's the most we see. FHAs are, there's no prepayment penalty. So you can prepay monthly, you can prepay if you sell, you can prepay if you hit lotto, you can prepay if you refinance. So if you got an adjustable and interest rates plummet 4 or 5 years down the road, you could refinance into a fixed rate. It's called an FHA streamline. Probably wouldn't make sense because your rate's gonna drop if rates go down. But you do have the right, there's no penalty.
No, I mean, like, with this one, like with the hybrid arm, for example, you said it's fixed, say it's fixed at like 3% for like the first 5 years, after that 5 years, say you want to stay in that house, you don't want it to like go like really high, it's on that like.
You could refinance,
Yeah.
yes. The answer is absolutely. Okay?
Can I just answer your first name is? Phyllis.
Phyllis, you posed a very good, thought regarding, it sounds like it's a subprime. When we counsel individuals in terms of a fixed rate and an adjustable, if that loan, which it is insured by the federal government, and the hammer that Congress has given this industry over the past 2 years, if there was any hint that that was not a program that was good for certain individuals, believe me, the FHA would have taken that program and just tossed it out over the last 2 years. But they haven't. Because of that 1%.
So what you're saying is basically some people would not be qualified to take this loan?
No. Some people would not want to take that loan. Some people would only want a 30-year fix.
You'd have to qualify for a loan, whether it's a one-year
Right, but I'm
adjustable,
just
or
saying,
3 or
there
5
are
or 50,
groups
you still have to
where-
qualify.
You have to have a certain amount of income just to get this type of loan?
No different than a
Oh.
fixed rate. Matter of fact, it would be easier on a 5-year adjustable because the start rate is lower than a fixed rate, and you qualify at the start rate.
Because I know a lot of people took those subprime loans with in mind that I'm gonna have this house for 5 years, and then by 5 years, they decide, oh, I wanna stay into this house. 10 years coming down the line, and the rate has gone sky high, they can't afford the property.
You're right, those
So
are,
that's what I'm saying about this loan, it just sounds like under the table, it's like a subprime loan, it sounds like.
no, it's not.
Yeah,
Sub-
because they know it's gonna go on.
subprime loans.
Only up by 5.
You just said it, subprime loans, there were 2 major subprime loans, what are called 228s and 327s. Those were the predominant subprime loans. You get your rate fixed for 2 years. After that, it adjusts every 6 months. Most people didn't know that. Some of them had very high caps, some had no caps at all. Those were dangerous loans, and that's what got our business into a lot of trouble. The pay option loans that I mentioned earlier, those were loans where you didn't even have to pay the principal and interest. You didn't even have to pay the interest due. You could have paid a set number, a low number, every month, and your mortgage balance is going up, not down. That's a dangerous loan. This is not. This is a government-insured FHA that's as safe as could be.
Because if your mortgage is constantly going up and your income is not going up,
You got a problem.
you got problems.
Yes, you do. Agreed. The next, reverse mortgages. This is something that's gained popularity in the last couple of years. Without going into great detail, a reverse mortgage is available to people who are 62 years or older and have equity in a property. You can also use it to purchase a property. Now, as the name would imply, it's a reverse mortgage. You don't pay the bank pays you. You can get that money in a lump sum, you can get it in monthly increments. The interesting part of the reverse mortgage is, since you're not paying, they're not checking your income. You don't need it. Since the bank is giving you the loan based upon your age and your equity, there is no credit. You could have horrible credit and qualify for a reverse mortgage. If you have questions about it, we'll obviously go into great detail if you ever come across someone who's in the ballpark for a reverse loan, which means 62 years of age can be used as a purchase or refinance.
Excuse me, how does that benefit someone who's purchasing?
Assuming you have a substantial down payment, because it's going to depend on the value of the property, you almost always need, I'm going to say, a good 40% down. If you lost your last house because it was a foreclosure, you can't get a regular mortgage. You have enough money for substantial down payment. When you're over 62, you can use the reverse to purchase something. Remember, there's no income and no credit check, because the lender is giving you the money, you're not repaying it.
I understand, how is the lender giving you the money, and
The
you're
lender-
sending your paycheck every month, is that what you're saying?
You could do it monthly, you could get a lump
Because it's
sum.
actually taking the equity out of the house.
Correct.
So when you're ready to sell the house, you really won't lose nothing.
You have to pay a mortgage on it.
Or you want to,
It's a mortgage, it's a lien against the property.
because you're still on the line.
You have to, you could live in that house till you die. And now your heirs have to pay off that mortgage.
So if you want to sell that house, it's not a good idea, if you have to live in that, it's a good idea.
It's just like any other mortgage, in that it's gotta be repaid, the house is sold.
It should be like a second mortgage on the house if the house.
It's a first mortgage, it's gonna be in first position. The difference is the lender gave you the money when you took the loan out, and they collect the money back when the property is sold. All right?
So they would have paid off the original mortgage?
Sure. Yes. The next on my list, FHA 203K. That is a rehabilitation loan. That is an FHA insured mortgage, which we do at Continental, that allows someone to purchase the property with the same minimum 3.5% down, plus finance the cost of the renovation. It's the only way that I know of to get a mortgage, a loan, on a handyman special, on these bank-owned properties that have no kitchens and baths and no heating systems. Okay, the properties you need is a substantial renovation. You can't move in and live there. 203K is the solution. It's also the solution if someone simply wants to improve a property. They're gonna buy it, there's nothing wrong with it, but the kitchen is 25 years old and the wife wants a brand new kitchen. You can use the 203K to do that.
So the person will be paying two mortgages at the same time?
Nope, it's one mortgage. It's one loan that does two things. Lets you purchase and renovate, lumped together. That's really all you need to know. It's available, that's the most important thing. If you're showing a house that has no kitchen, no heating system, how do you finance it? Well, you can pay all cash, the customer could, obviously. You don't need a mortgage. But if you need to finance it, the K is the way to go. Okay?
So the 203K is what the property would be worth once it's removed.
Pardon me?
The 203K, when you take out the loan, is what the property will be worth?
Correct.
Will be worth
That's what
future,
drives the
once
program.
you take out the
The value that an appraiser puts on the house when he's doing the 203K appraisal is the value when the house is repaired. Okay? So if you're buying the example that's easiest to understand, you're buying an 800 square foot ranch. And for part of the K, you're gonna add an extension out back. You're gonna add 400 square feet. When the appraiser appraises it, he's gonna comp it out to 1,200 square foot ranches. He's gonna comp it to what it will be. That's why a 203K loan is often for more than purchase price. All right? For today's purposes, you just need to know that the product exists. It's there when a property needs major work. It's also available when someone wants to do minor work. You can use it for purchase or refinance. Next, commercial loans. A commercial loan is a loan on a property that is not a 1 to 4 family residential. It's used for mixed-use properties, apartments, 5 families, 6 families. It's different. It's outside the Fannie, Freddie, FHA, VA mortgage. There is no active secondary market for commercial loans. We do them, we act as a broker. We broker them to one of the handful of local lenders who do commercial loans today. Next, property types. I just mentioned 1 to 4 family residential. That's the typical house you're going to be selling. Your typical mortgage is going to be secured by a 1 to 4 family residential property. But there are other types. Condominium. Condominium is a bit different because there are common areas. You own the unit, but you share these common areas, which could be a parking lot, a gym, a swimming pool, and of course there are fees associated with this, common charges. From our perspective, mortgage financing, nowadays, to get an FHA loan on a condominium, the condominium project has to be FHA approved. So we check a list to see if it is. We're also able to approve projects ourselves. We can get a developer approved FHA. We do it ourselves. Conventionally, it's a little bit tougher. You need your 20% down plus closing to get a condo loan for the most part. It is possible to do a 90 LTV. You need your mortgage insurance. Cooperatives. We see a lot of co-op sales lately. When a person is buying a co-op, what they're buying are shares in a corporation. They're not buying real estate. They're not buying real property. They're buying shares. The biggest issues we see is that the co-op project has to be on an approved list. We check that before we begin. The other issue is the co-op board has to also approve the customer. And that can be a nightmare if you've ever experienced that. Someone can have a mortgage in place, the project's okay, and the board doesn't like something about this borrower and they don't approve it. So co-ops face a different set of challenges. Yes?
For purposes of financing on co-ops, what's the rule of thumb for the percentage of owner-occupied units that you look for in a co-op in order to finance it? Or it's just on the list?
It's either approved or not approved.
Oh,
Okay, but when it comes to financing, FHA does not finance co-ops. The other issue is the co-op project itself will establish a minimum down payment. There are projects where they require 25% down, some require 20, and some will let you get away with as little as 10. Yes.
How does Sony May work with cooperatives?
I've done a Sunny May loan on a co-op. They'll look at, they have to approve the project, it has to be on their approved list, and the borrower has to qualify under the normal standards. So
And
we
if it's
can-
not in their list?
If it's not on their list,
Excuse me, yeah, I know. It's an what they do is they have some guidelines from like what we used to have years ago. The owner-occupied percentage and how many units have already been sold. And I think, although I'm not certain, owner-occupied has to be 70% of the total units.
so Sunny May is
So
gonna
it's
look
not
at a
that they
co-op.
approve the whole project.
They're gonna look at a co-op questionnaire and judge the co-op just like they're gonna judge the borrower.
It could be possible if it's not on the list. It
Yes,
could be
is.
added to
I-
it. That's what
I previously
that's what it
said
is?
was incorrect.
Yeah.
That's
Thank
why
you.
Mike is here.
On co-ops, how do they get on the list? Do you know?
You know what, that's a
Is
good,
it-
I don't really know.
Because I was told previously that, that it depended on, like, financing a co-op today is difficult, but it has something to do, I thought, with the percentage of owner-occupied units.
It
that
does.
The building has.
It has something to do with the co-op's financials.
Right.
If the co-op is operating every year at a dramatic loss, investors are gonna toss them off the list.
Right.
And co-op loans are not as available as a regular loan. There aren't as many investors out there who will consider co-op loans. So we always start with that list.
And those
Yes.
maintenance charge, sorry.
If a co-op corporation does operate at a loss and then eventually what happens? They go into foreclosure or?
No, what they'll do is they'll simply raise the common charges to offset the loss. It'll be more expensive to live there, and
Right.
more difficult to sell. Okay, I have a co-op loan closing tomorrow. It was like pulling teeth getting the financials from the board, but once we got them, it was approved. I found out yesterday from the attorney that the common charges are going up because there was a slight loss. So the borrower is gonna end up paying more on this new unit he's moving into. Yes?
What if the shareholders refuse to pay?
They
Like,
never
I'm
do.
asking because
Well-
I have a building now where they're increasing substantially. Well, not increasing, but they're adding to, like, let's say the charges they're already collecting, they're adding like $400 extra per shareholder. I mean, based on this, I guess, number of shares, per month, they're gonna add like $400 more. And the building, everybody's going crazy because they're saying, we don't wanna pay.
Well, if people don't pay,
On top of, you
then
know,
how
what
do
Then
you
it's gonna
they're
go down.
provide
paying.
services that people are expecting if there's no money? If the roof leaks and there's no money to fix the roof, the people on the top floor have a problem.
But could they send that corporation into foreclosure or into bankruptcy?
I think the answer to that question is gonna be by an attorney.
Yeah, yeah, I'm not gonna pretend that I know the inner workings of co-op boards. I'm not sure what'll happen. It can't be anything positive though, that I can assure you. There's one point I wanna make on co-ops.
Those charges cover various things in various co-ops and various.
Yes,
condos.
basically what they cover is the underlying mortgage that the project has. Projects always have big mortgages, those mortgages have to be paid. The maintenance, the monthly fees go to pay that, amongst other things. There is something else on co-ops, which is always an issue. It's called a flip tax. Anybody ever heard of a flip tax?
Before you go for it, I just wanna be clear on that. So, you're buying it for, you got a mortgage and you have to maintain the
You have a co-op loan, technically, it's not a
co-op loan.
mortgage.
So you got it, and the maintenance charges, they can go up, they can vary according to.
Sure. They can vary according to the management. If, you know, if you get hit with a storm and the roof of the building blows off, well, you've got to pay to put on that new roof, don't you? Somebody's got to pay. Who's the somebody? The owners of the corporation, the shareholders. The flip tax. A flip tax is a fee that is paid by the seller. It's imposed by the co-op board when they sell. Now, not all co-ops have flip taxes. They can vary from a minimal amount to zero to tens of thousands of dollars. So there's a wide range that directly affects the seller, but it also affects the buyer, which a lot of people simply don't know. The buyer doesn't pay that flip tax, but that flip tax, if it's over 3% of the purchase price, is going to reduce the loan amount. So they're going to need more cash. I just met someone last week who was looking to buy a co-op in a project not far from here, in fact, right down the block. They required 25% down, and we found out that there was a $15,000 flip tax on this particular unit. She didn't have the money, so there was no deal because it would absolutely affect her. So co-ops with big down payment requirements and flip taxes can be troublesome. You need to know it affects the buyer. I've had people tell me, absolutely not, it doesn't affect the buyer. It does. It reduces the loan. That's what I want you to know about flip tax.
Paid by the seller?
It's paid by the seller. Okay, the board imposes it. Again, it's an amount that's going to vary wildly. It could be zero, it could be a set fee of $250. It could be dependent upon how long you've lived in the co-op. Each board is different. Remember, these are private corporations. They make up their own rules. But it does affect the buyer. That's the one thing I wanted to make clear.
Yeah, I've seen that with the buyer, they pass it over to the buyer, the tax.
I suppose you could do that. You know, that's a part of negotiation, right? Here's the price plus the flip tax.
I've seen somewhere that it says right on the MLS sheet that if the seller's making a profit, then they have to pay a flip tax. If there's no profit, they don't pay a flip tax.
Okay, that's that co-op's rule. All right?
Who decides
The board, the corporation, the co-op. I guess their thinking in some cases is if you profited, you want a piece of your profit.
And you said if it's over 3%?
It's a factor. If it's under 3%, it's not a factor in terms of financing. That is a rough rule. It's not a rough rule, it's the rule. Okay. All right, what's next? Closing costs. In your handout, actually, it's kind of at the end. It's not in the right order. I put in what's called a pre-disclosure proposal. This is a real proposal on a real deal, and it's got a list of closing costs. These are the things a buyer would pay. This is what closing costs are composed of. So we can run through it quickly. Top left-hand box, those are the lender's charges. Application, processing, underwriting fee. Second box down on the left side is an appraisal fee and a review appraisal, if applicable, if needed.
What are the monthly talking about? Yeah.
You're looking at the wrong form. All right, on the right-hand side, your credit or points. This is a 1-point loan. So the points are 41, 42. Okay. The next box, title charges. Settlement or closing fee. That goes to the bank attorney. Title insurance fee. Both the lender and the borrower are covered, insured. Those fees are set by New York State Department of Insurance. So we've got to disclose them. The next set of fees down there, recording fee. Your mortgage and your deed are recorded. Local municipalities charge a fee. And then the big one, the largest single expense, state tax. And here in New York, it's called a mortgage recording tax. You pay both the city and the state. It's the largest single expense a borrower will incur. On a typical loan, it's 1.8% paid by the borrower. The lender, by the way, also pays a quarter point. The second section down, estimated reserve prepaids. These are monies that go into escrow or are prepaid. Left-hand side, prepaid interest for 30 days. That's the interest that's collected at the closing, from the day of the closing to the last day in that month. So this proposal is an estimate of 30 full days, which is the most it could be. Obviously, it could be less depending upon the day of the month you close. Mortgage insurance premium. This is an FHA loan. That 4101 is an expense the borrower incurs, but it's financed. It's almost always added to the loan. It could be paid in cash, but the FHA allows you to finance it. So the vast, vast majority of people finance that mortgage insurance premium. Hazard insurance premium, $1,500. We're estimating that someone's going to buy an insurance policy, and it's going to cost them $1,500. They're going to pay the insurance company, and that policy is going to be in effect the date of the closing.
Okay, if you were to pay this up front, you wouldn't have that PMI on your loan?
No, that's different. We'll get to that. This is upfront. What you're referring to is monthly. FHA hits you twice. Okay? The right-hand side were estimates of the money that's going to go into escrow. 2 months worth of hazard insurance, and in this instance, we're estimating 5 months worth of property taxes. And then that column at the bottom, everything is all added up, including the dollar amount of the down payment. In this case, the borrower needs $39,017.94. We as a lender would have to verify that they had at least $39,000 assets. Okay? So this is a sample. It's not a good faith estimate, because I intentionally use this document because a good faith estimate combines several of these fees, and you'd never figure it out. I'd be here for an hour just trying to explain it. This form makes it a lot clearer. For your purposes, you don't need to know everything here. You need to know that there's this thing called closing costs, which most people estimate at around 6% of the mortgage. Okay, that's a number that's supposed to rent. 6% of the mortgage is more than a 3.5% down payment. Okay. The solution to that, I'm jumping out of the way. What's a solution? We're going to skip one. A solution to someone who does not have closing costs. They don't have all this money. It's called a seller concession. Everyone familiar with the concept? Essentially, the seller is going to pay the buyer's closing costs. Some of them, sometimes all of them. It's a concession. That dollar amount is almost always added to the final purchase price. So a buyer may offer $400,000 for property, but he doesn't have closing costs. So we're going to refer to that as an unaccepted offer. The seller can't accept $400,000 because the buyer doesn't have enough money to close. There's no deal. But if the offer is increased to $420,000 and the seller pays $20,000 of the buyer's expenses, now there's a deal. So that $20,000 is called a seller concession. The buyer gets his cost paid by the seller. Okay? It's extremely commonplace, as those of you who've been around for a while know, especially on FHA loans. FHA will allow a 6% concession to be combined with a minimum down payment of 3.5%.
Does the property has to be appraised higher value at that price?
Absolutely.
I guess that's what.
That's the price. It has to be appraised for the price. So it does not work if this $420,000 sales price, if an appraiser goes out there and says it's only worth $380,000 or $400,000, it doesn't work. So that is something that you have to be very much aware of. Another little issue that comes up is it'll never work if the property is listed for less than that amount. You'll virtually never see an appraiser appraise a property more than the list price. Okay, that's sort of a red flag. I skipped one thing, transfer tax. That's an issue. Transfer tax is a large amount of money that is traditionally paid by the seller. It's paid to the city of New York and the state of New York. New York City gets 1% of the sales price. If it's less than $500,000, the state gets $4 per thousand. So just on a $400,000 sale, that's $5,600 that the seller pays. So
Could you repeat that again, please?
under 500. and it's 1.425 over. You know, I don't think it's important to know.
500 or 400?
500.
And the state was some?
And the state is $4 per thousand of participants. The point we're trying to make here is not that you be experts in calculating taxes. That's a legal thing. You need to know that new construction and on certain short sales, these expenses are sometimes passed on to the buyer. Okay? It's typical in new construction. The builder, in his contract with the buyer, will state that the buyer is going to pay these taxes. That's a big chunk of money added to the normal closing costs. You very often see it on short sales, where the short sale lender, if they've agreed to this short sale, they're going to pass, in some instances, that cost on to the buyer. That's the point of me discussing transfer taxes. It's both. It's city and state. So basically, government, city and state, collects from the seller, the buyer, and the lender.
Each of them would collect 1%, or the 1% would be laid include them?
I just told you, the state is $4 per thousand, and the city is 1% of the sales price, unless it's over 500, then it's even more. Bill, the important point is that you've got to be leery on short sales. You've got to be aware that the lender, the existing lender, may force the buyer to pay these expenses. It'll be in the contract. We, as a lender, when we disclose closing costs, we've got to know that. Because we've got to tell the buyer in writing that he or she is liable for these transfer taxes. If we don't, if we screw up by entry, we can't collect it at the closing. You know who would be liable? So, on a short sale, new construction, we really need to analyze that contract carefully to make certain that these costs are not being passed on to the buyer. Okay?
Say a short sale, can be careful to pass on to buyers?
Yes.
Now, how is the seller supposed to pay the transfer tax when they're already in a financial, negative financial?
That's exactly why it's passed on to the buyer.
Oh,
The seller has no money, and the short sale lender, they want every penny they can get. So they're saying, you, Mr. Buyer, you've got to pay these taxes. That happens.
So the buyer's attorney is better make sure that they eat that, but the bank eats that.
It's a matter of negotiation. Either if you want the house, and the seller, the short sale lender rather, is insisting on this, you either pay it or you don't buy the house.
Most times, Cheryl, it's the bank that's receiving the shortage of money that directs that the transfer taxes be paid by the buyer.
But normally it's paid by the seller.
Normally it's paid by the seller.
Just to go back, if there's a property, and it's, for instance, I'm losing my property, it's now authorized for it to be a short sale, how do you know what to set the price of that property
If
for?
you're a seller and you're involved in a short sale, that's essentially, your house is not worth what you owe. You
Right.
can't sell it for what you owe, so you're gonna sell it for less. You're gonna sell it for whatever someone is willing to pay. The short sale lender has to agree to take that loss. Okay? If 500,000 is owed, but the thing is only, today it's only worth 400, you can't sell it for 500, it's not worth it, no one will buy it. So it's really a matter of the marketplace. What is it worth in today's market? That's number one. Will the buyer buy it? And number two, will the short sale lender agree to the loss that they're gonna incur?
Okay.
Are they gonna take $380 of mortgage proceeds when you're owed 500? That's a business decision they have to make. That can drag out the process if you've ever been involved with a short sale. Okay. All right, we're getting to the end of our definitions. Where are we? LTV down payment. Loan to value ratio. We touched upon it earlier. A conventional loan is one where the loan to value ratio is 80% or lower. The flip side of that coin is the down payment. If the LTV is 80, the down payment's 20. If the LTV is 70, your down payment's 30. If your LTV on an FHA is 96.5, your down payment is 3.5. It's just the opposite side of the coin. Okay. Banker/broker. This is a distinction I like to make because it's important. We are a banker. We lend money. That's what you need to know. A broker is a middleman. A broker is someone who might take a mortgage application, they might process that, but they're not gonna make the lending decision. They're not gonna approve it or reject it. A lender is, and they're not gonna lend you the money. The lender is. Okay, so very often people refer to us as mortgage brokers, the mortgage bankers. Continental is the bank. Take the application, process the loan, underwrite the loan, we lend the money. We're responsible. That's a basic difference between banker and broker. Brokers are under enormous pressure today. There are many, many fewer of them. And starting 2 days ago, the way they get paid has been changed. The business is getting very, very difficult for brokers to survive. Okay. Short sales, we kind of already talked about that. A short sale is a situation where the property is no longer worth what is owed. And the existing lender or lenders, sometimes there's two, very often there's two, have to agree to take less money than they're owed. So that can make the process drag out. That can make the seller really irrelevant. The seller isn't making this decision. His lender or lenders is making the decision on whether to accept this deal or not. Next page, REO, real estate owned. We're all familiar with bank-owned properties today. It's the term that's used. The bank is foreclosed, they own the property, now they put it on the market to sell it. Very often those properties need a lot of work. We talked about the 203K being a solution to that problem. Underwater, that's a term that you heard recently. Underwater means that you owe more than your property's worth. You're underwater. A much bigger problem in other states, but a problem here also. Your house is worth less than you owe. The mortgage balance is $500,000. You can't possibly sell it for more than $400,000 because that's what it's worth today. Underwater. Liz Pendens. That leads to a short sale, exactly. And if the short sale doesn't occur, the bank would end up foreclosing, and that leads to an REO bank sale. Liz pendens is a term that's become common. Literally, it means lawsuit pending. We give you guys a product named Geodata. In Geodata, you can go in and check Liz pendens. You can do it by zip code, you can do it by neighborhood. You can actually determine if a Liz pendens has been filed before the homeowner gets the notice. Okay? Bad news for the homeowner. They're losing their house. Modifications, another recent term. You've all heard it, I believe. A modification is something where someone has fallen behind. Maybe they're on the verge of foreclosure, and they're trying to get their loan modified by the existing lender. Restructured. Maybe the rate reduced. Maybe the term lengthened. Maybe the arrears put on the back end of the loan. But the idea is to make it affordable for the homeowner to stay in the home, to avoid foreclosure. Modifications. There have been a tremendous amount of talk about it, but not a whole lot of them have actually been done.
That obviously has a negative impact on the borrower, right, when they do a loan modification. Can somebody see that, or?
Sure. If you run a credit report on somebody who's looking for a modification, you may see a horrendous payment history. They've fallen behind. I've dealt with people who haven't made a payment in 2 years. We can't do anything for them. They're not credit worthy to get a new loan. The only thing they can do is negotiate with their lender to make their existing loan more affordable. Sometimes it works, sometimes it doesn't. I'm just trying to make you familiar with the term modification. All right, we've run through the definitions, but I realize I skipped something. In your handout, I included a very simple form of the documents that are needed. You kind of already touched upon this. Pay stub, W-2s, tax returns, part of what a buyer needs to bring to us, and bank statements covering 2 months. That's proof of both income and assets. I kind of skipped it. It's in the packet. The other thing I skipped, and I think this is worthwhile, not for you to become an expert, but I do want to show you with these two handouts. One is, it's page 2 of the mortgage application. All right, and what I've done on this, to get to that page, I circled 3 numbers. The first number in the top right-hand side, $1,886.85. This is a real deal, by the way. That's the borrower's proposed housing expense. Their mortgage, their insurance, and their taxes. It's a Long Island property, you can see their taxes are pretty substantial. So that's their proposed housing expense, $1,866. Okay. The number to the left, $4,512. That's their monthly income, base pay and overtime. No, pardon me, bonuses. $4,512. The way mortgages are approved or not approved is by what's called ratios. The first ratio, the second handout explains it, but if you follow me here, you'll get it. The first ratio is the housing expense divided by the income. So the 1886 will be divided by the 4512. That gives us a first ratio, which comes to 41.8%. It's on that second sheet. That's a little bit high, 41.8% first ratio. But this loan was approved because the buyers had excellent credit and there is a very low LTV, putting in a lot of money. Okay, so a 41.8 ratio was borderline, but with these real positive factors, it was approved. The second ratio, which is sometimes referred to as the debt-to-income ratio, is that first number, that 1886, that's their housing expense, plus the number I circled on the bottom, the $90. That's their recurring debt. They've only got $90 in recurring debt. They don't have big car loans or leases. They don't have a lot of credit. They've got good credit scores, but as you can see, 1, 2, 3, 4 pieces of credit. The total is $90. The second ratio is calculated by taking the housing expense, 1886, 85, plus the 90, and dividing it by the same income. And that produces, as the sheet shows, a second ratio or bottom ratio of 43.8. That's solid. So this is a good loan because there's very little debt, a very big down payment, excellent credit scores, and they can basically afford it. This is what loans are approved by, or denied by, ratios. And we're certainly not asking you to do that. That's what we do. But I just want to make you aware that there is no quick and simple answer to see if someone qualifies. Because underwriting it's risk assessment. And we're assessing 3 different things: the income, the assets, and the credit. So the stronger 2 elements are, the weaker that third element can be to get someone through. If all 3 elements are real strong, well, that's a piece of cake loan, nice and simple. Income, assets, credit, what we talked about earlier. Okay? And again, the income produces ratio. So the question we always get, and I'll try to answer it as best I can, is there a shortcut? Is there a simple way to know what someone will qualify for? I know what they make. They're a bus driver, they've been on the job for 8 years, they've got a certain amount of money for down payment, their credit is good. They make $50,000. How much will they qualify for? A rough rule of thumb in today's market, given today's interest rates and today's taxes, roughly 4 times your annual salary will get you the loan. So $50,000 in income will get you roughly $200,000. That is a very rough guesstimate. That's not how loans are approved. They're approved by ratios. So will that work if someone has $2,000 worth of monthly debt, a big car loan at least? No, probably not, because the second ratio would be way too high. But as a rough rule, you can think 4 times the annual earnings will get you the loan amount. Add to that your down payment, and you're in the vicinity of what someone can afford. Very difficult today for one person to qualify. That's what I've seen. Real tough, because there's only one income taken.
Tony, can you just go over those two ratios again, the front end ratio and the back end ratio?
Let's look at the ratio worksheet I provided, that handout. I included page 2, just to show you where the numbers come from. The first ratio, called your housing ratio, your first ratio, sometimes the top number, it's got a lot of different names. It is essentially the relationship between your housing expense and your income. Your housing expense, in this case, $1,886, divided by the income. That's giving us a housing ratio of 41.8. If this were an FHA loan, there'd be mortgage insurance involved, so the housing expense would be higher, it'd be tougher to qualify. But these people are putting down way more than 20%. The second ratio, or the bottom ratio, often referred to as the debt to income, takes into account your housing expense plus your other debt. In this case, most borrowers have minimal debt. On a monthly basis, only $90. We sometimes see people with $1,200, $1,300. Sometimes their debt, their monthly debt is more than the mortgage payment. So that makes it extremely difficult to qualify on the second ratio. Now, this is a good question, I just thought of, a good point. What does work and what doesn't work? If you look at the FHA guidelines, they say the ratio of the first should be 33 and the second 41. Those ratios are exceeded routinely today. We see first ratios, well, you see right here, 41, and we see second ratios as high as 50, 51, getting approved. Okay. So that's the good news in the mortgage business. Ratios have been expanding. When I started in this business, it was 28 to 36. If you were over 28, you weren't getting along. Today, again, we routinely see first ratios in the low 40s and second ratios in the high 40s, even low 50s. Okay. Everybody clear? Again, we don't want you to calculate ratios. You don't have to do them. You just have to know. I want you to know that this is how loans are approved or disapproved. That's why all three elements come into play. Someone could have terrific income, and they could have a good down payment, but if they've got a tremendous amount of debt, that second ratio might not work. 5 years ago, it didn't matter. You put them into a different product where you didn't have to qualify. Those days are gone. All right? Any questions on that? Getting close to the end, and my last topic is just a little more detail on FHA financing in general, because we see a lot of it, we do a lot of it. So the last handout, the last page rather, FHA financing advantages. We've already touched on many of those advantages.
Hey Tony, maybe you can just share with everybody the reason why FHA has become so prominent and popularized today.
Okay, that's right here, that's what we talk about. Why is FHA so prominent, so prevalent? A couple of reasons, yes.
You don't need the full 20%.
I'm sorry, can you?
You don't need a large down payment. You can put down 3.5%.
That's a huge advantage. That's a huge reason why it's popular. Minimum down payment of 3.5%. More expanded qualifying ratios. It's easier to qualify ratio-wise on an FHA. They're more flexible. It's easier credit-wise, slightly easier. Okay, a company like Continental, since we're a direct Ginnie Mae lender, we don't have to worry about overlays that investors apply. We look at the merit of the loan, and if the loan makes sense, we'll do an FHA loan where the credit scores are below 640, below 620, sometimes below 600. Mike has a deal right now where the guy's credit is pretty lousy. He's putting out a lot of money, and we've done that deal. No other bank can touch it because the scores are just too low. Right, so FHA is used for that a lot. By the way, the 3.5% down payment on an FHA, that applies to 1, 2, 3, and 4 family properties. No other loan does that. So you could buy a 4-family if you're going to live in it with 3.5% down. Okay? We've already talked about seller concessions. FHA financing will allow a 6% seller concession which should cover all of the borrower's closing costs. So what does the borrower need? The 3.5% minimum down payment. Those two things are the biggest advantage of FHA. Less money out of pocket. And that seems to be the biggest obstacle for most people, to accumulate enough cash to cover their down payment and closing costs, particularly in the boroughs. We've got that big mortgage tax to contend with. 100% gift funds. All of the money in the transaction could be a gift. So you could technically do a deal where the buyer has none of their own money, zero. The sellers pay all their closing costs in the form of a concession, and you're getting a gift for the entire down payment. Pretty good deal. Now, obviously, the other elements still apply. You've got to have good credit, you've got to have enough income, okay? But you can maneuver on an FHA with money. A minor point, but it's worth mentioning. Rental income. You've heard me talk about giving credit for rental income from that second, third, or fourth unit. FHA will allow us to give 85% of the gross amount. So if you've got 3 apartments in the 4th family that are worth $1,000 a month, we're going to give $850, $850, and $850. 3 times $850 is going to be added to the income to qualify the borrower. Conventional will only give 75%. So it's another small advantage, but an advantage that FHA financing provides. The other thing I threw in there is the 203K. It's a rehabilitation loan. You should just be aware of it. It's a little technical. We could take that up as a separate topic. I've done it many times in the various offices. But that's an FHA advantage, the K program. So when you combine all of these things, low down payments, rental credit, 100% gifts, 6% concessions, combined with the low down payment and 100% gifts, you put all of this together, FHA has soared in popularity in the last 2-3 years because of those other products disappearing. Much of what we do goes FHA. Anytime someone has a small down payment, which is often, this is the way to go. Yes?
This is not only for first-time buyers, right?
It is not. That's a misconception. Some people think you have to be a first-time buyer. What you have to be is an owner-occupant. You cannot do an FHA loan if you're buying a second house or you're buying for investment purposes. It's for owner-occupants only. So you could be in contract to sell your house and you want to buy another one. You're not a first-time home buyer. As long as you sell first, you can buy that second, and as long as you move into it, you gotta live there. Owner-occupant.
Can you rent the first house out?
Good question. You could, however, that changes the rules, okay? Because now you've got to qualify counting the old mortgage and the new mortgage. All right, that's tough. And we as a lender have to know you're going to move in. Because if you haven't moved in, that's fraud. And we're going to check it. If it's obvious to us you're not going to move in, we're not going to do the loan. Okay. There is another rule out there. It's called buy and bail. If you're going to leave your house that you currently own and rent it, we can actually count the rental income, the proposed rental income, as long as we can document it with a lease and a check from your new tenant giving you 1 month's security and the first month's rent, and you've got a certain amount of equity in that property. So I said the rules change. It gets a little more complicated when someone already owns something and is looking to go FHA.
We take it from the mortgage and that too, the mortgage payment.
You have to. It's their obligation. It's on their credit report. It could be offset by rental income if they have a certain amount of equity and you document the rental income. But the rule is called buy and bail. It's new, of course, like most of these rules. It was created because a lot of people, I saw it on Long Island, they buy a house, they pay $500, a year later it's only worth $400. It is real. So they could buy one around the corner for $400. So they would do that. They buy that new house for $400 and walk away from the old one. They bought and they bailed.
When you say walk away, they sell it or just walk
No,
away?
they just
Away.
walked away.
It was into
So what
foreclosure.
happens when they credit them?
Oh, the credit's
Well, they've already
destroyed,
bought the new house.
but they're already in the new house.
Huh?
They're already in the new
Oh,
house.
okay.
So the new rule now tightens the guidelines up, but we can't just say they're going to rent it, here's a lease. We've gotta really know they're gonna rent it, and we're gonna ask for extra documentation, and they've gotta have equity in the property, or buy and bails. To prevent that from happening, FHA found there were a lot of delinquent loans that came up that way, the result of someone buying new and bailing out on the road.
Um,
Yes, you got a question in the back?
Yes.
if you